Hello, property navigators. Now, as you may have heard, Australia's weekly median rent has hit a new record, meaning renters are paying the most they ever have. If you are an investor, this can be really good news as it directly affects your property cash flows. Now, I want you to understand what all this means. So I'm going to dive into this topic and explain how we got here, how the data is analysed, and how the data is presented, and what that might mean for investors in the long term. CoreLogic recently announced that the median rent across Australia rose to $601 weekly, resulting in an annual median rent of $31,252. Now, this median rent figure from CoreLogic is derived from current rent income estimates of both houses and units, indicating the rent price for an average Australian dwelling if it were listed on the market today. The reported $601 weekly median sets a new record and aligns with the national annual rent growth of 8.3%. Since August 2020, when the weekly median rent was $437, and as you can see on screen, there has been a significant rise, which has increased the annual rent figure by over $8,000 during this period. You can also see that rents have rarely ever gone down in the past decade and a half, according to the Rental Value Index. The Australian Bureau of Statistics Consumer Price Index, which has tracked housing costs as part of inflation for about 50 years, tells a similar story. So we know there isn't going to be a drastic or exponential drop in rents in any case. Now, this is pretty huge growth which has happened literally before our eyes in just the last few years. So how did we get here? The average annual increase in rental values was 9.1% over the last 3 years, which sharply contrasts with the 2% yearly growth seen during the 2010s. But why? Well, let's start with what COVID did. The pandemic's onset triggered several factors which helped lead to significant rent increases, including a noticeable reduction in average household size from late 2020, largely due to fewer shared housing situations, necessitating more homes even when population growth was nearly non-existent in 2021. The average household size dipped to a historical low of a little below 2.5 people per household due to the pandemic. 2. A swift rise in Australia's population starting late 2022 following the easing of international travel restrictions. Check out our video on that below. Now, this resulted in a fresh surge of migration as the government worked to clear the migration bottleneck that built up through the COVID-19 years. Number 3, a temporary dip in investment in housing between May 22 and February 2023, caused by rising interest rates. Now, although investor activity has since rebounded significantly, there remains a considerable gap in establishing new rental properties. Additionally, long-term trends have also heightened the demand for rental properties. The decline in the availability of social housing as a percentage of total housing over the years has intensified pressure on the private rental sector. And although home buyers are still very active in the market, meaning that rental properties purchased by owner-occupiers further reduces the level of available rental accommodation, it must be noted that there has been a constant falling home ownership rate over the past few decades, which means that a higher percentage of Australians are renting now more than ever before. Even prior to the pandemic, the average size of Australia's households had been slowly decreasing for years due to both economic and demographic reasons, such as an increase in single-person households and more people really wanting to live the single life or the city life or choosing not to have kids, leading to a need for more homes to accommodate the same number of people. This shift to smaller households created a structural shortfall of about 120,000 homes. Experts point to several other factors that are still today driving rent increases, including shortages of building materials, slowing down construction, increasing numbers of short-term rentals such as Airbnb, and recent higher income growth for some. All this added in on top of years of housing under supply now has higher rents hitting the 1/3 of our population who rent. So how does this look? Increases in rental costs have generally surpassed growth in wages, inflation, and incomes nationwide, exacerbating rental affordability issues. The share of the average gross household income needed to cover the median rent increased from 26.7% in March 2020 to 31% by September of the previous year. Now, to put this into perspective, although servicing a new mortgage requires a significantly larger portion of income, renters typically have lower incomes. Recent data from the Australian Bureau of Statistics indicates that the median gross household income for renters is 41.8% less than that for homeowners with mortgages. So for this roughly 1/3 of our population, it very well might be that renting a property could be their only real option forever. So where to from here? I bet you're asking, will rent growth start to slow? Well, that's a yes and a no. While annual growth in rents is higher than historic averages, it has broadly slowed down a bit across Australia. In 2023, rent values rose 8.3%, down from a peak of 9.6% in the year to September 2020. But here I want to remind you, as I always bang on about, that every state and territory, region and suburb operates as its own market. And we are talking about data here citing Australia's rental market as a whole. Even as the national averages have hit new heights, they may obscure a different trend in particular locations or in unique circumstances. There really isn't a national rental market, but thousands of smaller ones differing on things like price levels, location, and factors about the properties themselves, such as the number of bedrooms. So while individual cities may have had periods where rents became more affordable, it would take something large like the pandemic for it to show up when measured nationally. As you can see on screen, we have a graph for each capital city showing the 12-month percentage change in rents. Just ignore the different colours for now. You can clearly see that different cities are increasing or decreasing values at the same time. For example, looking here in 2024, Sydney and Perth are increasing, while Adelaide and Darwin are decreasing. But all of these cities are getting analysed together, collectively, when we take a national average. Just something to keep in your mind when we're taking in these headlines. Now, getting back to the question, to talk about the slowdown and speed up of rental markets, we need to segment this a bit further to understand the question. Looking at the graph on screen, we can see the recent slowdown has been most evident across regional Australia, where rents rose 4.3% last year, down from a 13.4% rise in the year to August 2021, when a lot of people were getting out to live regionally during the pandemic. The slowdown in capital city rent growth began more recently, and you can see on screen it eased from a peak of 10.6% in the 12 months to April 2023 to 9.8% by the end of the year. And remember, this data from CoreLogic is live data. CoreLogic's rent value index often precedes changes in the consumer price index for rents. This happens because CoreLogic's figures are based on the rents advertised, which is basically up to the minute data, while the CPI reflects the rents the households have actually paid. Due to the nature of lease agreements, typically lasting for 12 months, the rents that people pay tend to be more stable compared to the advertised rent values. But the downside is there's an average 6-quarter delay between shifts in CoreLogic's data and the CPI rent figures. On screen, you will see a graph illustrating CoreLogic's yearly change in rent values for capital cities against the CPI metric. But already, recent trends show a decrease in the monthly CPI rent growth from 7.6% in September to 7.1% by the end of November. This deacceleration in rent growth could be due to affordability issues pushing renters towards shared housing or more affordable areas. Also, a rebound in investment activity over 2023 might be gradually mitigating the pressures on the supply side. But capital city house rent increases have sped back up. While the recent slowdown in rent increases is a positive sign for controlling inflation, there was a slight uptick in annual growth in the last quarter to 2023, indicating a resurgence in rent prices. This increase was most notable in the capital city housing markets and was also observed in regional rental markets. A contributing factor to the renewed growth in house rents could be the trend of households moving back into shared housing arrangements. Also, something very interesting, the gap between the rents of houses and units has decreased over the past 2 years, from a median difference of $63 per week to just $38 per week. This narrowing gap may make units less attractive, causing a shift back to house rentals. Despite the late 2023 uptick in rent growth, there is an expectation for a slowdown in late 2024, although I personally haven't seen any material change to supply and demand to evidence this slowdown. Nonetheless, some experts point to a number of factors for a future slowdown, including the trajectory of household sizes starting to rise again as more renters consider moving into share houses to make ends meet as rents become less affordable. Nonetheless, some experts point to a number of factors for a future slowdown, including the trajectory of household sizes starting to rise again as more renters consider moving into share houses to make ends meet as rents become less affordable, thereby increasing supply. Construction costs will also be easing, and government built and built to rent projects coming into the market. Other factors that have been suggested for a slowdown include an increase in investment lending, a return to normal levels of overseas migration from the extremely unsustainably high levels seen in the past couple years, and the big one nobody can escape commentary on, the possibility of a reduction in the cash rate. Now, be careful what you read and who you take influence from when it comes to understanding which factors contribute to increasing and declining rents. Let's look at the opinion of 3 of Australia's expert commentators on the topic of whether the forecasted plateauing and likelihood of an investment rate drop will play any part in rents decreasing. CoreLogic's head of research, Eliza Owen, says, as inflation moves past its peak, the RBA is getting closer to the end of rate hikes. She speaks to the graph that's now on screen, saying this could be good news for renters because growth in rent values usually tracks roughly with movements in the cash rate, which I guess can be seen to some degree in her graph. However, not everyone is quite so sure. Professor Alan Morris from the Institute of Public Policy and Governance at the University of Technology, Sydney, says he wouldn't like to be so definitive. There's a reasonable possibility that they will level out because the increases have been so tremendous that there's a point where people just can't afford those rents. But the lack of regulation means that there is a possibility that rents could continue to increase. We just don't know. Then we have Dr. Chris Martin, who's a Senior Research Fellow at the University of New South Wales City Futures Research Centre. And he's very similarly saying, I don't think there's a single relationship between interest rates and rents. I don't think we can conclude that the pressure being felt by rental households is expected to let up automatically. He added that supply issues could, in fact, see rents continue to increase for years to come. The rate of completion of properties is currently down now on what it's been in the last few years, certainly before COVID. On that reasoning, we still might have a problem on the supply side and pressure for rents to go up in the years ahead. Now, I've illustrated these different opinions here for you, so you understand that even Australia's most qualified or highly regarded experts have differing opinions, and that is totally okay. But it shows why it's important for you to understand how these figures are calculated and presented so you're properly informed. Here are the outtakes for you, ultimately things you need to keep an eye on. Firstly, as you should have realised by now, you shouldn't take the annual rent figure being at a record high as a single source of information as to the status of your rental cash flow. There are literally thousands of markets in Australia, so do your research and analysis, and at a much more meso and micro level than determining your property's rental value. That single exercise will allow you a much more detailed view of your property. You also want to be looking at market demand indicators. Record high rents often reflect strong demand for rental properties, possibly due to factors like population growth, insufficient housing supply, or changing demographic trends. Investors can use this information to gauge the health of the rental market and the potential for continued rent increases in an area. Now, you can use the above to reach a decision point for rent adjustments. Property investors might consider adjusting the rent of their properties in line with market trends. However, they should weigh the impact on tenant retention and the legal and contractual aspects of making such adjustments. This leads us directly into affordability and vacancy rates. While higher rents can increase income, they can also affect affordability for tenants, potentially leading to higher vacancy rates if rents outpace wage growth, especially in a specific area. Investors need to balance maximising income with maintaining low vacancy rates to ensure a steady cash flow. With rents hitting record highs, investors might need to make an assessment of yield versus growth when purchasing. This might involve a reassessment of focus between yield and capital growth. In high rent areas, the yield might become more attractive, though these areas might not always offer the highest capital growth. Be careful not to take an easy win and reach for cash flow purely over capital growth, as this could produce large amounts of opportunity loss for you in the long term. And lastly, something all investors need to stay abreast of, especially in today's environment, the potential for regulatory changes. Sometimes significant increases in rental prices can lead to regulatory changes or interventions aimed at protecting tenants, such as rent controls or more stringent tenants' rights laws. Investors should stay informed about potential regulatory changes that could affect their investment as it becomes more and more apparent government are trying to put out fires in relation to affordability. There is one thing that is certain when investing in property, and that is new policy and legislation will be implemented, amended, or retracted at some stage. Well, there we have it, property navigators. Any questions? Make sure you pop them down in the comments. Now, if you like this video, you should check out this one on Australia's surging population to give you some more insight in the supply versus demand of Australia's property market and what this means for you. Until next time, happy property navigating.